You know what? In real estate, a signed contract is just a piece of paper. The deal is not real until the funds are wired and the deed is recorded. I've seen seasoned investors lose six-figure deposits and months of work because one of the stupid mistakes in the final 24 hours. They treated the bank like a friend, but the bank is a calculator. And if the mess changes even 1% at the last minute, they will cut you loose without a second thought. Today, I am showing you the 4 ways you are accidentally sabotaging your own deals and how to keep your capital safe. Welcome back to Enter Talks. I am Davyd Kyryliuk. For us as investors, debt is a tool. It's the leverage that allows us to grow, but that leverage is fragile until the very last second. The bank is looking for a reason to say no. They are looking for any sign of instability that could threaten their position. If you want to play at the high level, you need to understand the rules of silence. During the closing period, here are 4 things that you will kill your deal right at the finish line. First, the trap of new credit. It's tempting. You have just secured a major property and you want to celebrate, maybe a new car or high-end equipment for the project. Don't! Banks perform a soft check just before funding. If they see a new inquiry or a new line of credit, it changes your debt to income ratio. For investor, this is lethal. Even 500 monthly payment for a lease car disqualify you from $1 million mortgage. Keep your credit profile frozen. No new cards, no new loans, no inquiries. Celebrations comes after the close. Point 2, the 120 days expiry. Complex investment deals often drag on permits, get delayed, or negotiations take time. Remember that your credit approval has an expiration date, usually 120 days. If you close that line, the bank pulls a fresh hard check. If your credit utilization has spiked or your score has dipped since you started the terms you fought for are gone. As an investor, you must manage your credit score like a hawk during the entire escrow period. Don't let a slow deal become a dead deal. Real estate is a game of details. I want to know, what's the closest you ever come to a deal falling apart at the last minute? How did you save it? Share your story in the comments. We learn more from near misses than easy wins. And if you are serious about building a resilient portfolio, subscribe to Enter Talks. We are here to make sure you stay on the right side of the numbers. The third mistake, changing your income structure. You might get a better job offer or decide it's finally time to go 100% into your own business. Wait. Banks verify employment 24 to 48 hours before closing. To a lender, stability is more important than potential. Even if you are going to earn more, a new job is a red flag for a bank's underwriting system. As an investor, your job is the golden goose that provides the bank with security. Don't kill the goose until the deal is closed. Finally, large unseasoned deposits. If you are moving capital between LLCs or taking a private loan from a partner to cover closing costs, be extremely careful. Banks look at large movements in the final days. If you drop $50,000 into your account and it has not seasoned for 60 days, the bank will exclude those funds from your assets. If you can prove it, a clean documented paper trail for every dollar you do not have a down payment in the bank's eyes. Keep your investment capital stationary and transparent. The bottom line: from the moment you sign the contract to the moment you get the keys, you must practice total financial discipline. Treat your credit and your bank accounts as a no-fly zone. No changes, no movements, no surprises. Your mortgage broker is your strategist. Keep them in the loop, but keep your profile clean. I am Davyd Kyryliuk, and this is Enter Talks. Let's make sure your next deal makes it across the finish line. See you in the next video.